Choi is a partner at HLM Ventures, a Boston venture capital fund that focuses on the healthcare sector. Before joining HLM, Yuman was an angel investor with Angel Healthcare Investors. He is a graduate of Babson College, and Yuman, thank you for joining us. So we'd like to talk this afternoon about your perspectives on the emerging company. And your vantage point has been both as an angel investor and a venture capital investor. Do you work with portfolio companies in different ways as an angel investor versus as a venture capital investor, or is it similar?
There are definitely similarities and differences, and it really depends on the type of investor you are. And even as a venture investor, there are some people that act a certain way and other people that act a different way. I'll try to categorize it in a few different sort of segments. The one is just a time commitment aspect of it. An angel investor, by definition, is someone that's investing their own money, right? And so they may be a very passive angel investor, meaning they just want to, put money into companies and walk away. And you call me if you need help, but otherwise, I'm just an investor. And that's a very common form of angel investing. And there are venture investors that have the similar strategy as well, whether they are on the board or not. They give them capital and say, here, this is your money, do what you want. And there are those with an investment philosophy that says, if I give you money, I'll give you my expertise and my time as well. And it can also depend on how much of an expertise you have on that particular field. So, for example, I'm a healthcare investor. If I make an angel investment outside of my field, which I've done in the past, I am less valuable to that company on that specific industry. I can be helpful in terms of thinking through strategy of the business or thinking about financing for the business, but those are more generic pieces of advice. So depending on that individual's philosophy of investing, they can be very active or not. The second thing that you want to think about as an investor is whether you're on the board or whether you're an advisor or you're not involved. For us as venture investors, we typically take board seats. And because of that, we have regular dialogues with the company. We have board meetings where we're looking at the strategy of the business, looking at financials of the business, and making some key decisions, ranging from hiring decisions to financing to should we go after this acquisition target, when should we sell the business, and we're privy to a lot of those conversations. Where as an advisor to a company, for example, you may be called upon, by the CEO, or if you have a particular expertise in the field, you may be helpful in attracting some customers or signing up some partnerships, right? But as a whole, it really depends on the philosophy you have and the role that you play in the company itself. And I think I read somewhere that in Harvard they did a study. There's 5 different phases of the business. There's a startup, and it sort of naturally flows into one or the other. And I can't articulate what those phases are, but
it probably ends with a sale.
It sometimes ends as a sale, maybe not a sale, but in those different moments, you may require different types of expertise and different types of governance structures. As a startup, it may be great to have some advisors, but it may not be advisable to have board of directors because it may slow you down. On the other hand, if you have great board of directors that can help you get plugged into the market, that have done it before, right? You get the CEO of FedEx to help you with your printing mailing business. That could be a great start to the business. So it really depends on what you're trying to accomplish with the business itself as well.
How about valuation metrics? How do they differ between angel investors and venture capital investors?
I would say it's very scientific, meaning it's not at all scientific. Valuation is one of those things that a lot of people like to talk about. If you've ever watched Shark Tank or any of these shows, it seems like people just throw out numbers. It really is dependent on the market. What I mean by that is if it is a very hot market, you are trying to start an e-commerce business, and the e-commerce, examples in the market are doing really well and people are throwing money at it, your valuation may be high. If you are a startup but you have an experienced CEO that's done, you have the former CEO of Twitter coming to, start a new company. You naturally may have a high valuation company, despite the fact that it's a very early stage company. So it's more art than science. And the things that we leverage to make sure that we're not either way off market or under market is by looking at comparable transactions and comparable companies in the market. What I mean by that is looking at other companies that have been financed in the same space.
So do you find yourself pattern matching? So when
Absolutely.
When a company
Absolutely.
comes in, so talk about that.
So, what gives me a more insight into valuation, for example, and just to step back, the reason why valuation is such a tricky subject is because valuation has a lot of strings attached to it, right? I'll give you, if I believe the company is worth $5 million and you believe it's worth $10 million, I'll give you the $10 million and I'll do other things to make sure that I extract the value from that.
Like?
There's control provisions, right? You can't sell the company for a certain price unless I approve of it, right? Or I can put liquidation preferences, meaning if you sell the company for $20 million, I get 3 times my investment up first before you get a penny, right? So there's different ways that I can structure a deal to make sure that despite the fact that you got a increase in valuation, maybe in the overall transaction, it's not as attractive. So, I do this day in, day out. So it's a lever. You give up one thing, you can always pull back on another. And if you think about, so that's sort of the overview of valuation. If you think about the amount of deals that I look at, I probably evaluate over 1,000 business plans a year. Really look at probably 200 business plans, at least more than just reading for 2 minutes. And then out of those, I'll speak to at least half of those, meet with them, and then dig into 20 of those companies and maybe get 1 or 2 investments out of that. So I just have a volume advantage that most people don't get. And so I have a good barometer for what a valuation should be in a specific market. I have a good idea of what the comps are in the market, right? What transactions are happening, what people are willing to pay for. So I have a pretty good idea, of if you went to another venture capitalist on the road, what they would be willing to pay for. So it gives me a unique advantage, versus someone that doesn't see the volume of deals that I do.
So let's talk about the management team. So if a entrepreneur comes into your office who's had previous successes, that's probably easy. But what about an inexperienced management team? What are some of the qualities that you look for that if you find, you might consider investing?
So if we look at our historical, portfolio composition, I would say half of the investors were very experienced CEOs. The other half were not experienced CEOs. And they might have been experienced. We always look for barometers. We look for things that indicate that you will be a successful CEO. And so we spend a lot of time doing reference calls, not just reference calls you provide us as the CEO, but reference calls from industry experts.
And what are you looking for? What are the qualities that
depends on the phase of the company, right? If it's an early stage company, do you have the charisma and the passion and the vision and the sort of relentless persistence to ride the ups and downs of a startup, right? Once you migrate more towards and key to all of this is, can you hire? So I look for a couple different things. One attribute is, can you hire great people, right? Hire and retain great people.
And if somebody's inexperienced,
yeah.
how can you assess that?
You don't have to have the exact experience of that. You can be a team leader in a role, right? If you were working for GE, but you had 5 or 6 people working for you, how was that interaction? We'll talk to those employees under him, employees or her, employees that the bosses of those employees. So you can get a barometer for, is this person able to really bring a team mentality to this? Are they able to identify talent? So there's ways of getting around it. It's not a perfect analogy. Obviously the best thing would be if they had done it before and they've built a great team and had a successful outcome. That's probably the closest analogy. But lacking that, you're looking for other evidence that will allow you to have better indications that that person will be able to emulate that and grow into that CEO role. My job is about risk mitigation, right? So if every checkbox that I can check is about decreasing that risk, and you're never going to be able to invest in a risk-free company, because by that time it'd be way too late stage, and even then there's always an element of risk. But for us, it's about making sure that we're decreasing the amount of risk for the value that we pay.
So you're an investor in the healthcare sector, and once you've invested in a company and you are either sitting on the board or monitoring its growth in some way, shape, or form, what kind of data, what kind of analytics do you look for in order to really assess whether the company's on track?
So there are a couple of different tools. One of the easiest is looking at the financials, right? Looking at financials, keeping track of metrics in terms of spend, in terms of revenue, in terms of profitability. A lot of these companies are not profitable, so how unprofitable you are. The net burn, meaning how much they're spending in terms of cash per month. So those are barometers that I use to keep track of how the company is doing. There's other metrics of success, retention of employees, retention of customers, customer churn, meaning do the customers stay with the company? If you have if the company is raising cash, how successful are they at raising additional cash? There's a lot of different barometers that you use and metrics that you're keeping track of to make sure that the company is on track. For us in healthcare, if we're investing in a medical device company, it's looking at clinical data. How are they doing? Right? What's the clinical data look like? What's the FDA doing? How are the payers responding? If we're looking at service businesses, for example, it's what does engagement look like? Are the customers? What's the pricing mechanism? Is the company getting to scale? So there's a lot of different terms that I'm throwing out, but it's basically a fancy way of me saying, is the company, once again, going back to the risk-reward profile, are we decreasing the amount of things that are unknowable and getting to a point where you're replicating the successes of the business? That's really what you're trying to get at, right? Decreasing risk on the one hand, and then replicating the successes so that you can really accelerate the growth of the business.
So last question, Yuman. If you were advising a CEO as to how to have an effective relationship with its investor along the way, what advice would you give?
The first thing I'd say is transparency. Whether it's good news or bad news, the investors are there. Once we invest in the company, we are shareholders. We're fiduciary responsibility. Our fiduciary responsibility is to make sure the company succeeds.
So let's drill down on that, because I've heard that said by investors a lot. And obviously you want to give them financial information on a regular basis. But can you think of an instance where you thought that a management team was not being transparent, that was not obvious to them, that they didn't realize that they were not being as transparent as they should have been?
There's always a trade-off, and I empathize with entrepreneurs tremendously. That to run the business itself is a tough job. Then to turn around and have investors that you need to make sure that they're being kept in the loop is another entire job. But as when you take on capital from an outside source, what you're committing is that you're going to let them into the fold of the business, essentially. So,
is it anticipating issues and talking to the investor about an issue that could arise before it even
It's having a dialogue.
It's
having a dialogue and saying, I don't know. Once again, going back to risks, right? I always sit down with the CEOs and say, okay, what are the things that can go wrong, right? What are the elements? I mean, let's forget about the risks that we can't control. The market crashing, we can't control that, right? A customer, getting pissed off and hating us, we can control that, right? And what are the elements that we can control to make sure that that customer is happy? Or what are the elements we can control to make sure that we retain our employees and are recruiting the best employees? I like to sit down with the CEOs on a regular basis, and once again, it depends on the stage of the company. Some companies, the CEOs call me weekly. If we have a specific situation where we're trying to win over a business or to do a business transaction, they may be calling me daily, all right, saying, "Hey, this is happening. What should we do?" And the reason why you take on capital from us, I like to believe, is because we can add a certain amount of value. I am not an operator. I'm not going to replace the CEO. I'm not there to run the company. I tell the companies explicitly that is not the venture capitalist that I am. There are some venture capitalists that love taking the operational role. That's not what I do. My job is to make sure that the entrepreneurs get the support they need to succeed. So for me, I am a sounding board and advisor, and I can use my network and experiences to help make sure that the company is not making the same mistakes. So if I don't know what the risks are or what the company is going through, whether it's good or bad, I can't be helpful in telling a company, yeah, this has happened in this other company, or I've had experience doing this, so this is how we work through that. Or this is the risk that's going to happen, so let's go down this other path, right? And those are things that we can't anticipate if we don't know what's going on with the business. So, once again, we're not asking to be in details if we don't have to be, but the CEOs, the best CEOs are the ones that can to concentrate the issues at hand, prioritize where the risks are, and is able to communicate that effectively to the board and get help and feedback.
All right. Well, listen, on that note, thank you, Yuman, and really appreciate all your great advice and
Thank you.
insights. Thank you.